Crypto interest accounts are growing fast. What should investors know? Have you guys ever wondered why crypto interest accounts are growing fast? Why are investors interested in passive incomes these days? Let's find out more in this video. There has been a dramatic uptick in conversations around trust-paying crypto accounts. So what should potential investors realize both in terms of pros and cons? Crypto markets continue to embody the idea of price volatility, with the double-digit percentage swings in prices being a routine occurrence in different crypto assets, even as stablecoins and other tokenized assets are more integrated into the wide discussions. There is still an association with the volatility for many crypto assets. Hi investors, welcome back to Daily Crypto Facts. If you want to invest and fill your mind with the right information, you are at the right place. In today's video, we will analyze why crypto interest accounts are growing fast. Make sure to hit the like button and subscribe to get big updates about stocks and cryptocurrencies. Adding in recent comments and actions taken by policymakers in the United States and abroad, and the desire of more stability, no pun intended, ways for investors to generate returns, the appeal of interest-bearing crypto accounts should be obvious, particularly in an economic environment where interest rates are being artificially suppressed and with other assets trading either at near all-time highs. The idea of being able to earn passive income at higher rates has led to a rush of investment to an array of the products. Many firms have launched and rapidly expanded operations seeking to capitalize on this growing demand. With such rapid growth, however, it is important to look beyond the appealing rates of return being offered and understand some of the factors that should inform the investor's decision-making process. Let's take a look at some issues that every investor should take into account when analyzing which, if any, interest-paying crypto options are the correct fit for them. Number 1. Centralization risk. This should go without saying. But the very fact that organizations are offering these services does lead to the intermediary and institutional affiliation that some crypto proponents might not be a fan of embracing. These risks are no different from the risk that investors take on a routine basis with incumbent bank financial institutions and brokerage. But this is worth pointing out. In addition, opening accounts at these institutions require fulfilling the full array of know your customer compliance measures. Whether a specific investor subscribes to the notions of not your keys and not your coins is not the point. The fact is that these offerings are divergent from the decentralized idea of crypto. Number 2 is fees and balances. Something that gained attention following the direct listing of Coinbase is the fee that can often be affiliated with crypto transactions at centralized organizations. While incumbent brokerage have reduced fees to zero in many cases, the transaction fees charged by crypto organizations can come as a surprise to some investors. Additionally, while most crypto organizations don't have minimum or maximum balance limits, the balance being transacted can all be impacted by fees. Highlighted by the recent conversation around the gas fees on Ethereum blockchain, the fees involved can take a sizable chunk out of certain transactions, especially ones with lower amounts. Issue number 3 is differing payouts. There are indeed no or few minimum balance requirements at crypto banking organizations, but the amounts that are on deposit can impact the rate of return that is earned. For example, the higher value of crypto that is on deposit at a specific organization may lead to that investor earning a lower rate of return. This is subject to change and modification by the organization, but again, is something to keep an eye on. Issue number 4 is variable rates. One of the strongest appeals of crypto interest-paying accounts is the much higher rates that are offered when compared to fiat-based savings or money market accounts. One could make the argument that these higher rates are primary reason why this facet of the crypto landscape has attracted much of the attention and investment flows. But interest rates can change. Interest rates can and have been increased or decreased or otherwise modified as market conditions have changed and evolved. While framed as a passive income approach, investors should still periodically check and confirm just what interest rates they are earning. Issue number 5 is the form of payouts. One another factor that is need to be understood is what form the interest and earnings will be denominated. Will these payments take the same form as the initial fund deposited, or do they take an alternative form? There are pros and cons to any approach offered clearly. It is something that, firstly, crypto needs to be researched by investors, and secondly, monitored for any changes as market conditions change the ability of investors to earn interest and passive income on crypto deposits. Although introducing facets of decentralization represents an important step in the continued integration, maturation, and adoption of crypto assets options, such innovative thinking has in turn been rewarded in the form of increased attention. Investing in many of the organization is great news, simply because passive income never truly is passive, and crypto interest options are not dissimilar from other fiat-based options. In that sense, that said, like any other investment decisions, multiple factors need to be taken into account and examined by potential investors before allocating the funds. We will talk about how you can get the most out of your cryptocurrency holdings by earning interest with cryptocurrency interest accounts. We'll be talking about the BlockFi interest accounts, Crypto.com Earn, Nexo interest account, and Celsius Network. There are a lot of platforms out there, but these are the ones that we had experience with and have heard great things about. For those of you who want to take advantage of these interest rates but don't want to expose yourself to the crazy volatility of traditional cryptocurrencies, you can opt to earn interest on your stable coins. BlockFi. BlockFi was founded in 2017 and is a privately owned NYC-based lending platform. It stands out by having institutional backing from some of the largest names in the finance industry, such as Coinbase Ventures, SoFi, Fidelity, and more. They offer three main services: interest account, trading, and crypto loans. Earn up to 8.6 per annual on your cryptocurrency assets, compounded and paid out monthly. Choose to earn interest in your chosen crypto with interest payment flex. No minimum deposit, no locking up funds. Crypto.com is one of the many companies that are trying to push massive crypto adoption by providing real-world use cases. My favorite products are their Crypto Visa debit card and their Crypto Earn feature. Earn up to 18% per annual on your cryptocurrency assets. Minimum deposit required depending on crypto. Required to lock crypto during earning period in terms of 1 month, 3 months, or flexible. Nexo has its roots in Credissimo, a publicly traded consumer financing company that was founded in 2007. Nexo gives clients the ability to earn up to 10% per annual interest on their crypto and fiat, as well as earn 2% cashback on all purchases made with their debit card. They also share 30% of company profit dividend payments with Nexo token holders. Celsius is a large player in this industry. They pay the highest interest among those on my list. Choosing to earn interest in Cel, the company's utility token, gives you a higher interest rate. So, what's your take on this? Do you think this will be the best stablecoin to invest in? Let us know in the comment sections below. If you have liked this video, give it a big thumbs up and share it with your friends who are looking for real and smart cryptocurrencies updates.